Hey traders. For this lesson, we're going to examine the differences between being long and short, as well as explain how shorting actually works. We will also examine some rules and regulations related to stock buying and selling, or longing and shorting. First off, we will simply define the differences between long and short. Being long in any stock simply means you purchase a stake in that company from a seller. You now own this position and can sell it when the time comes to close out of the position. Your profits or losses can be calculated by taking the sale price and subtracting this from the purchase price. In order to be profitable in a long position, the price of the stock must go up. Being short in any stock means you are selling stock to a buyer that you do not actually have. In order to sell stock that you do not have, your broker or clearing firm must have this stock available to be shorted. Basically, what is occurring is you are borrowing this stock from someone else who is currently long. You are then selling this stock on your own account. Your profits or losses can be calculated by taking the sale price and subtracting it from the purchase price. In order to be profitable in a short position, the price of the stock must go down. A few terms associated with being long and short are buying, selling, shorting, and covering. Buying is when you are going long in a stock and you are initially opening your position. Selling is when you are closing out of your long position in a stock. Shorting is when you are selling stock to go short and you are opening your position. Covering is when you are buying stock to end or close your short position. Most people, especially investors, have a negative feeling towards shorting. In fact, in September of 2008, during the market crash, shorting of stocks was outlawed by the SEC. It is important to acknowledge that shorting of stocks is an important and critical aspect of a healthy market system. In early 2009, the SEC voted to possibly reinstate the uptick rule. For those of you who don't know, the uptick rule states that you cannot short a stock unless the last sale price was on an uptick, or it was higher than the previous sale. This rule existed for decades but was recently abolished. When shorting stocks, different brokers also have different regulations. For example, some brokers do not allow stocks under $5 to be shorted. Others have different margin requirements for shorting of stocks that are at different price levels. It is also important before you try to short a stock to ask your broker if they have a list of stocks available to be shorted. Most direct access brokers will have a symbol on the level 1 or level 2 screen which indicates whether or not a stock can be shorted. That was a brief overview of the differences between going long and short, as well as some of the implications of the two. For our next lesson, we will examine how account size and margin influences your trading. Until then, and as always, we wish you the best of luck with your trading.
Hey guys, for this lesson we're going to discuss account size and margin and how this can affect your trading. The first thing to keep in mind about account size is for a typical day trading account, you must have at least $25,000 in your account at all times. Most people getting involved in trading struggle to pull together this kind of money and then still have money to risk with their trades. This causes many new traders to become fearful of trading, which is an awful psychological state that is difficult to break. With that in mind, new traders opening a day trading account really should have at least $30,000 in their new account and fully expect to lose some of that money at first. The reality of trading is that most new traders, if not all new traders, lose money at some point in their trading. Most people have a difficult time grasping this concept that they will lose money. Think of this money as your tuition for learning about how markets work. For traders who do not have enough money to get involved in the stock market because of the pattern day trader rule, there are some alternatives. One is trading another market, such as Forex or futures. There are also some ways to get around the PDT rule, which I will discuss further and in depth in my course. The next thing to consider when day trading is margin. With a typical margin account, most brokers offer 2-to-1 margin, meaning for every $1 deposited, you will have $2 in buying power. With a pattern day trade account, however, most brokers offer 4-to-1 margin, meaning for every $1 deposited, you will have $4 in buying power. There are also some private groups which offer 10-to-1 or even 20-to-1 margin, meaning you could have $20 in buying power for just $1 deposited in the account. One major thing to remember when utilizing margin, especially 4-to-1 margin or greater, is that small price moves could greatly affect your account. For example, if price moves 1%, but you're using all of your 4-to-1 margin, then that 1% price move would actually have a 4% effect on your account. This becomes extremely dangerous when newer traders have positions going against them. So instead of following their trading plan, they decide to utilize more margin and average down their position. This is one of the most common ways newer traders blow out their accounts. Another thing to remember with margin is different brokers have different regulations on how you can use your margin. For example, some brokers will not let you trade stocks under $5 or under $1 and utilize margin. For these trades, they will only let you utilize your cash balance in your account. One of the great advantages of a margin account in general over a cash account is that margin accounts do not have any wait time for trades to settle. On a cash account, you must wait 3 days for your funds to settle from a trade. What this means is if we have a $5,000 account balance and make a $5,000 trade on Monday, we will not be able to make any more trades until Thursday. With a margin account, we still are technically waiting for our funds to settle. However, the broker will spot us the money while our funds settle. This is a huge advantage to having a margin account for any type of trading. So that was just a brief overview of account size and margin and how it affects your trading. For our next lesson, we're going to discuss technical analysis versus fundamental analysis and how they can be used in trading. Until then, good luck with your trading.
Hey traders, in this lesson we're going to cover the differences between fundamental analysis and technical analysis, as well as how you can use them both in your trading. First off, we will start with some basic definitions. Fundamental analysis refers to analyzing a financial instrument utilizing news stories, earnings, economic events, and any other similar source of information. This information is generally public information and easily accessed. Traders who trade strictly based on fundamental analysis rely on speedy and reliable news platforms to deliver this type of information to them so they can place their trades accordingly. An example of such a news platform would be briefing.com. Technical analysis refers to analyzing a financial instrument utilizing market data, market indicators, and charts. However, not all traders rely on all of these tools for technical analysis. Technical analysis typically utilizes different chart patterns, chart setups, and price movement to derive good entry and exit points. As a general rule of thumb, investors or long-term traders focus more on fundamental analysis, while shorter-term traders focus more on technical analysis. This is because company fundamentals are not always portrayed in the day-to-day price movement. However, technical setups exist every day. Personally, Shute and I rely on a form of technical analysis, but not conventional technical analysis. We focus strictly on price and volume to give indications of where we want to enter our trades. Conventional technical analysis does not rely on these two things as heavily as we do, but rather relies more on indicators, and in a previous lesson we covered why we personally do not utilize these indicators in our trading. Another thing to keep in mind when trading in the short term is that it can be extremely difficult to trade strictly on fundamental analysis without any form of technical analysis. For example, if we were trading Apple at $100 per share and they have an earnings release tomorrow which ends up beating the street expectations, more often than not the price reacts in a negative manner, which is referred to as buy the rumor or sell the news. Because of this, we personally do not rely on fundamental analysis or try to trade the news, but rather we are strictly mindful of when these news events are going to occur, and we keep an eye out for changes in price or volume that may signal that some sort of fundamental news is going to briefly overpower the technicals of that particular stock. With that being said, there are volumes of different aspects of technical and fundamental analysis, but this was a brief overview of the main differences between the two of them, as well as how we utilize them in our trading. For our next lesson, we're going to cover technical analysis on different time frames, such as the 1 minute, 5 minute, and daily chart. Until then, good luck with your trading.